All right. Today I want to look at the bond market, we'll look at the indices, and we'll also look at Bitcoin because I think this is definitely an interesting turning point in the market, and there will be a lot of decisions made from these turning points in the market. And the first one I want you to pay attention to is the bond market, because here we can see that TLT, which is the 20-year Treasury bond ETF, is starting to break out of a downtrend. And I talked about this before to pay attention to this level right here at 90, because if we start breaking above 90, we were getting higher lows and higher highs, which is definitely more of a bull trending look compared to what we had of lower highs and lower lows, which was this downtrend that we've had. So anytime the bond market is trending higher, you have to ask yourself, why is it trending higher? The number one reason the bond market would be trending higher typically would be just as a hedge against a recession, and you wouldn't see the bond market trending higher if it was worried about inflation. So going into recession would definitely be a good reason not to be worried about inflation, because you're not going to have inflation if you're in a recession. And if you're going into a recession, that's a great time to be in bonds, because you're more than likely going to see a bull market in the bond market if we are going into recession. So I don't want to speculate too much about whether or not we're going into recession. I personally don't think it's time for a recession just yet. But that doesn't mean bonds can't start doing well here, and that doesn't mean money won't flow into bonds preemptively. Anticipating a recession could be around the corner. Even if around the corner meant it was still a year away, I still think money could be flowing into bonds and trying to get ahead of it. So on TLT, we are at a very interesting level because we're right here at a 200 daily moving average. So we're not out of this bearish trend yet because we're still below the 200 daily moving average, but in the short term, we definitely have higher lows and higher highs as long as we're above 90. So pay attention to the bond market. I think it'll tell you a lot right here. If we start to get a rejection here, that's telling us that the bond market was just a counter trend rally within a bear trend. And that does mean bonds could still be going lower. This was just a counter trend within a downtrend before we go lower. And the real break of the downtrend will be a higher high breakout above 94, which you can see on the left of your screen. That was the high that we had back there in December. So if the bond market gets back above the 200 daily moving average and out above 94, that is telling you lots of money is flowing into the 20-year Treasury bond ETF, which is more than likely telling us there's fear of recession or economic weakness around the corner, and money is trying to get ahead of that. Keep in mind, the bond market is a smart money market. A lot of dumb money doesn't even trade the bond market, so a lot of the money here is definitely well informed. So I would not ignore the bond market. If it is telling us that we're going into a very powerful bull trend, that could be very concerning for the stock market. And if money is flowing into bonds, it's more than likely leaving somewhere, and it could be leaving stocks to flow into bonds, and that would obviously be bearish for the market as well. So I'm not telling you which one is going to happen because obviously we have no idea. It's a lot easier to know this critical level right here, right around 92.7, and then watch to see if the price is heading higher above it or getting rejected and heading lower. And in my opinion, the most bullish thing the bond market could do would sort of just chop around within a range and not get the rejection or the bull breakout, because this would tell us things are just Goldilocks. They're perfectly fine as is, and the bond market has no reason to have a strong reaction in either direction. And I think that would be a more bullish outcome for equities and stocks in general. Now, another thing we need to talk about is Bitcoin. I made a video about how Bitcoin was likely coming down for a 20% crash and how it was imminent right here around this candle on February 24th. And since then, we went all the way down to 78,000, which was about a 17% pullback. But more importantly, I don't think this is over yet, because I told you on the breakdown, we would likely get a retest. So we came all the way down to 78,000. We had a very impulsive bounce all the way back up to the breakdown, which was below 95,000. And from there, we're getting a very high volume rejection from that retest, which to me tells me we're not done yet, and we could still be coming down to at least 73,000. So while we're below 95,000 and definitely while we're below 92,000, I do believe Bitcoin is still risk off, which means Bitcoin is still in a downtrend. And this is just our new lower high rejection at 95,000. And this is still a lower high than the previous lower high rejections we've had. And of course, we now have the lower low breakdown below 92,000 with that wick low that we had down there at 78,000. So it doesn't look like the Bitcoin bulls are out of the woods just yet. It still looks like a downtrend. It still looks like a double top rejection, and it still looks like it could be going lower to at least 73,000. So keep that in mind. And if you want to get bullish, that is fine. You just need a break above 95,000. And if you do get that break above 95,000 on a higher low, that would be anything above 78,000. Then you could start to get more bullish here on Bitcoin. But I would give it plenty of time and plenty of confirmation that we are indeed getting a trend reversal. And Bitcoin is just one of those things that there's a lot of hype around right now. I personally don't understand it, but obviously there is a lot of hype around it, and especially with Trump saying he's going to buy Bitcoin. But keep in mind, anybody can buy Bitcoin. Just because Trump wants to buy it doesn't mean it's a bullish stock all of a sudden. This is not a new thing. Anybody can buy this at any time, so try not to get get caught up on narratives or news. It's more important you understand these critical levels and the turning points in Bitcoin. And right now it is not bullish while it's below 95,000. So I really think it's that simple. The next thing I want to look at is bond yields. So keep in mind, if people are buying bonds, the yields come down. So something like TLT going higher is going to send yields lower, because as we get more demand for bonds, the yields pay out less. And this is typically a bullish indication for stocks. And you could see here, we do have a lower high into a lower low rejection on the 10-year yield here. And as yields are coming down, that makes growth stocks specifically more attractive, which is going to favor any stock like a tech stock, because as the yields go lower, the cost multiples look cheaper, and then it makes a lot more sense to own growth stocks. So while the bond market is starting to rally and yields are dropping, that also could be bullish for something like a tech stock. So you do want to keep that in mind as well. Now, obviously, if we had this scenario where money is going into the bond market because it's fearful of a recession, that could still mean stocks are being sold in favor of bonds. So it's not a perfect one-to-one correlation, but while the yields are dropping, this could lead to a very powerful rally in growth stocks, especially while we're getting this mass fear and capitulation in the stock market. So speaking of mass fear and capitulation, if we look at SPY, we did gap up today, but we instantly sold it all off, and we did make a lower low breakdown down below 585. And 585 on SPY is a very solid risk level here, because while we're below that, we could come all the way down towards 573. Now, if we can hold above 585 and continue to push higher, we really need to get back above 594. And if all of that starts to occur and we start to get bullish higher lows and higher highs on the chart here, which would look like a bounce off of the lows and a higher low into a higher high breakout, this would be your indication that this downtrend is ending. And until that happens, it is completely fine to stay risk off in this market, assuming it's going lower. So as you can tell, we have this sort of range bound market from anywhere between 608 all the way down here right around 580. And when you're in a range bound market, a lot of people get frustrated because they're looking for a strong, powerful trend in either direction, which means as we get near the bottom of the trend, the bears are getting all excited because they think we're going to get this bear breakdown and continue lower. And then near the top here, you can see we had this bull breakout, and the bulls are getting excited because they think that is the bull breakout and we're going higher. But what ends up happening in a range market is that the breakouts typically fail. And that's exact same thing you saw in this bear breakdown here back on January 13th. Range bound markets love to whipsaw you in either direction. So anytime you get a breakout of a range bound market, it is typically going to be a breakout that fails, and then eventually you'll get the breakout for real, and that will be the direction the market wants to trend. But I do want you to be aware of that. In a range bound market, you're usually just ping-ponging around, and it could be very frustrating for trend traders, and it could be very profitable for short-term minded swing traders and day traders who are taking advantage of the volatility and couldn't care less if the market is in a strong trend or not. So with that being said, I think SPY 580 is very important because that is the bottom of the range. And I would not be surprised if we did get a little bit of a fake out below the bottom of the range and then still get another rally attempt to push back towards the top of the range. And again, this could go on for as long as it wants to. We really would need a solid break and close down below 580 and a trend continuation lower. And that could be where the bears start looking for a push down to 560, or we need to see the bulls starting to get higher lows and higher highs and getting back out above the top of the range, above 608. And then obviously that's going to take a lot more time because we're sitting here at the bottom of the range. It's going to take a lot more time in development before we see any sort of bullish development to the top of the range. So keep all of this in mind. I think it's important to understand the market is not going to break out of the range until price proves it. Anybody trying to predict when and which direction is more than likely going to continue to get it wrong. I think you are much better off simply picking a risk level on the chart and then trading around it, and then focusing on what you are better at trading at, whether that's longing or shorting. Because in a range, you should be able to do both as long as you're waiting to go long at support and waiting to short at resistance. So down here near support, look for the bulls to possibly buy right around SPY 580. And if SPY fails to hold 580, you'll be looking for 573. The bulls have everything to prove here at the bottom of the range. And if we do start to bounce and we start heading higher for the bulls, we'll need to watch to see if price can reverse the trend and start getting higher lows and higher highs. On the NASDAQ 100 triple Qs, we were down 2.19% today. And very similar to SPY, we have this range bound market. The range here is between 538 down here right around 500. And as I warned you with the ranges on SPY, you do get failed breakouts all of the time on ranges, like above here when we were breaking above 538 and then had that very impulsive rejection. And now I would caution the bears for the same exact thing as we come into this gap close right here at 492.88. This could be a failed bear breakdown below the bottom of the range, and then we could get another impulsive rally back to the top of the range. So it's very very common that breakouts fail in range bound markets. This has been a range bound market going all the way back to October of 2024. So 4 months now of really just sitting right around these same price ranges and bouncing around between the highs and the lows. So what I would be looking for here is to remain very cautious while we're below 500, but be open to the idea of a bear trap false breakdown below the bottom of the range, and that would be an impulsive rally, which would at least take us back higher towards 516 or at minimum 510. If it was a confirmed bear breakdown, then you're looking for the rejection failed attempt to hold below 500, and in that event, we would start looking for a push down into the 470s. If we cannot hold down below 500, consider that a false breakdown, which is also considered a bear trap, and that would be that impulsive rally, which would at least take us back towards the middle of the range. So I know ranges can be very confusing and very frustrating for a lot of traders, but if you learn to embrace the volatility and trade the range, it can also be very profitable. And I do want to caution you, this high volume, while we're getting mass fear, capitulation, and panic, usually does put in a bottom. So I'm very hesitant to say that we're entering any sort of bear market or bear trend. This still looks like a range-bound market that is about to trap a lot of bears, which will also mean that market makers selling puts are going to make a lot of money because they're selling those puts to you at a very high premium with a very high VIX. And then when we get that false bear breakdown, those puts will all go to $0 as we rally, and anybody selling those puts is going to make profit. And that is a very profitable trading strategy if you have the premium to sell put options. If you don't know what I'm talking about, that's completely fine. It's a more advanced strategy, and you can make more premium when everybody is fearful and they're buying the higher premium on the insurance that a put option offers you. So the number one message I could deliver to you tonight is stay extremely laser focused and disciplined. Don't be faked out by range trading. These breakdowns fail all of the time. And right now we're in a current situation where the bear breakdown could be faking out the bears and it could lead to a bear trap. But with that being said, you also have to manage risk because the longer we hold above 500, the more it looks like a legitimate bear breakdown. And then you obviously don't want to be holding long positions within a downtrend. And you also have a very clear risk level at the rising 200 daily moving average right around 493. So I think it's very easy to manage the risk, but you have to leave the emotions on the sideline. You have to have a trade plan around the price action and then let the price action guide you on when you should be buying and selling, and never ever forget to manage risk, because at the end of the day, a great trader is a great risk manager. If you want to come trade with me, the best way to do that is TSC Trade Alerts, where you get the exact buy and sell alerts for the percent allocations that I am taking for the TQQQ and SQQQ. And you can find out how to join the TSC Trade Alerts by clicking on the link in the description of this video. So thank you for watching, everybody. Now go crush this market.